by the way, thank you for taking the time to come here today. And I think it's interesting in terms of the placement and how some of the editorial conversations have been curated here. So from Paul Chan, we've had pretty much a very big presence of private market allocations and conversations. We just had one with Lulu, of course, and we have, of course, Chris here from PAG, and shortly after this, Apollo is coming on as well with Eric, and I think that's a really good sort of place to start. We were just having this conversation before we came up here. In terms of how you think global investors are under-allocated to this part of the world, I wonder if you could support that with some numbers, Chris.
Yeah, I mean, I think traditionally there has been this trend. You go to the US first, and then you go to Europe, and then you do a little bit of Asia, and you still see that in the numbers where APAC is 37% of GDP, global GDP, but only 15% of alternatives. So, I think the region continues to be relatively under-allocated. I have to say, hopefully that is starting to change. We've definitely seen in the last 18 months starting to see some pickup again, as I think our clients we talk to are generally all looking for a little bit more diversification in their portfolios and starting to look more at the region as well. So, on the positive side, that means there is, relatively speaking, less competition. So that's good.
Right.
But I think overall it's still, very much under-allocated. And I guess we'll talk about some things, but I think there's actually some real positive factors that hopefully should change that over time.
What do you think the reasons are behind that under-allocation? Is it home bias? Is it lack of opportunities? Is it politics?
I think obviously there's been a bit of geopolitics in recent years, which has affected some China allocations perhaps, but I think, there's still, I was talking to one allocator yesterday who still said, oh, we do whereas the US and Europe have actually seen a reduction, greater concentration. Asia total market cap is now more than double Europe, and trading volumes are 8 times Europe. So, I think there's a lack of appreciation in just how much markets have grown, the depth of markets, and the quality. Again, one area we're active in is convertible bonds, for example. 80% of Asian convertible bonds are large cap versus 50% in the US. It's again, the Asian convertible bond market is bigger than the European convertible bond market now. So, there's quality, liquidity, has grown dramatically, and obviously it's easier to quantify that on the public side, but you also see that on the private side. So I think, there've been some fundamental changes as these keep on developing that, haven't quite perhaps been recognized yet in allocations, but that should hopefully change.
Private credit's come up, as you know, I'm sure you've seen the news. Where are the best opportunities in your view for private lending, as far as you guys are concerned?
Again, I think Asia is a little bit different on private credit to US and Europe. US and Europe very much dominated by corporate, dominated by sort of mid-market lending, sponsor-backed financing. Those are the big sort of giant blocks of private credit. And, when you look at Asia, the markets are just a little bit better banked. The lending gap is smaller. The regulatory and burden on the banks has been a little bit less, particularly on the corporate side. So we've just seen less opportunity there. The pricing is not so interesting. where Asia has seen more regulatory sort of pressure on the banks in terms of capital charges, it's been on the real estate side. So we actually think that, that's where, we're one of the largest private debt credit firms in the region. Stuff which, so you're going up the risk
curve and everything else.
Yeah,
okay.
Yeah.
Before we get into China, because once we get into China, that's quite a deep hole we'll get into. But just the opportunities outside China as far as real estate and your franchise is concerned, like what's been most active for you this year, and where do you think things will remain active?
Yeah, so real estate, again, is a major business for us. We're, I guess, most active in 3 markets currently, Japan, Korea, and Australia and New Zealand.
Sure.
Japan continues to be, a great market. Again, that corporate governance reform theme pushing through, there's just so much activist capital now pushing public companies to, streamline, sell non-core businesses, so it creates opportunities for private equity, but also, corporate Japan still owns huge amounts of real estate, which really is non-core to the businesses. So just earlier this year, we led the acquisition of Sapporo Beer's real estate portfolio in Japan, which was a $3 billion transaction, and we're seeing, again, just more and more pressure on companies to sort of sell their non-core real estate. So we think this is a theme that has legs, and that corporate governance theme, again, drives lots of opportunities in Japan across multiple asset classes.
Let's bring China in.
Yeah.
I guess the starting point there, just to build on what we started on, just how underweight global investors are. So maybe just a mental exercise. Let's say you went to the US, a room of 10 people, and you brought up the topic of China, how many would remain in the room? How many would walk out?
I'm not sure they would. I'd hope they wouldn't walk out, but yeah, I think there's still probably 9 out of 10 people will just not do China in the US. So let's see. I think maybe there's a little bit
Has that changed?
Friendly relationship. It hasn't really changed yet.
Okay.
I think a couple of years ago, maybe people didn't even they weren't even interested in asking, I think now people at least are interested again from a macro point of view, what's going on in China, but not allocating capital yet. Maybe a little bit on the public side, but on the private side still, I think there's, from the US, not much interest.
Sure. Your call on China is underpinned by your view on the macro.
Yeah.
We've had this conversation, and I think what underpins that macro view is what happens in the property market. I think we have a graph. Thank you so much. Right on cue. Yeah. Thank you to our producers here. I think what you're looking at, just for the audience, this is a month-on-month change in, I believe, new home prices across 70 cities. This is across 6 years. So effectively what you're seeing here is for the better part of the last 6-7 years, it's been declines month on month. As far as new home prices go, what's the direction of travel that you see? And does this need to improve for the macro to turn?
I think, China's growth in recent times have been really largely driven by exports, and consumption has stayed very weak. And,
right.
We believe, we've strongly felt that household consumption is not going to return until the property market stabilizes. This was a major hit to household balance sheets and really impacted confidence. So we've been watching very closely to see, when are there signs of that property market stabilizing, and also watching at the same time consumption to see, because while this property price crisis has been going on, Chinese households have been saving like crazy. So there's about 23 trillion RMB of household cash savings in the bank. And you only need a little bit of that. 3% of that is a 4% GDP impulse. So we believe once that comes out, it could be a huge demand impulse into China. Some of that will also go into equity markets and other investments. And that can be, I think that's something, that's an extra sort of boost to China and the global economy that maybe isn't fully sort of baked into people's assumptions. So I think that is there. But, so I think the property market is looking a little bit better.
Okay.
In first-tier cities, prices are starting to stabilize, even go up a little bit in Shanghai. In second-tier cities, the rate of decline is slowing. We did last year the buyout, we led the buyout of Wanda Commercial, which is the largest
that's right.
shopping mall manager in the world.
Not a lot of people know that. You're actually the biggest mall operator in China.
Yeah, it's an amazing business, actually. So it's very interesting seeing the retail sales data across the whole country. And again, for the first time, we've actually seen the data tick, sales per visitor actually tick positive. And then we do sentiment surveys among staff, et cetera. And again, we've just seen little signs of things turning positive. So I think, this is something which, it may be slowed down a bit by Iran, and if there's some demand destruction on the sort of side through that. But I think at some point in the next 12, 18 months, I think there's positive. You could see a nice demand impulse coming through that could create then more employment, positive cycle through services employment, because again, manufacturing is not really generating new jobs. I think you could see a nice virtual cycle coming through in China. So that's something which, again, we're fairly positive on the outlook for China.
Okay, on the hedge fund side of the business, this might apply to China, it could apply to other markets as well. You firmly believe this is a stock picker's market?
Yeah, I think the market has changed. I think people always talked about the death of active investing, the death of stock picking. It's all passive, huge money going into ETFs, et cetera. And I think there's been some elements of truth to that. But again, we've seen, and it really started, I would say, around Liberation Day, so with tariffs. Okay, a lot of export firms in the region, lots of winners and losers, or relative winners and losers. I'm starting to see dispersion really pick up significantly. Then we also, obviously, we have the corporate governance reforms in Japan, which had a huge impact. Korea now looking and taking inspiration from that with their Value Up program. China also looking at some of those lessons learned from Japan. You've seen dividend payouts go up dramatically in China over the past 2 years. So, we've just seen, we have in our hedge fund, our polymer hedge fund business, we have 70 teams running different strategies across the region, mostly equity, long, short. And we've just seen the hit rates go up dramatically. Just seen dispersion go up, hit rates go up, and performance has been excellent. So I actually think a lot of these factors have some legs as well. Also AI, of course, again, another factor, global factor, creating more dispersion, more winners, losers, outperformance, relative underperformance. So, I actually think could be heading into a really great period for equity, long, short, and sort of stock picking in general.
Sort of within your verticals, then, do you think that specifically hedge funds will provide likely the most alpha this year?
I think there's lots of interesting stuff, actually. I think actually the lending is great. The real estate's been good. Energy transition, another theme we really like. The public performance it's been our record year for performance from our hedge funds, actually. It's been a great environment. Buyouts in China, we think, are really interesting now as well, actually.
That came up earlier, too,
because, again, there's very little competition. Valuations are reasonable. you cannot borrow cheaply. You can borrow more cheaply in China than Japan for a buyout.
That's crazy if you think about it.
Which is really amazing. Yeah. So, I think there's actually lots of interesting stuff, to do across the region.
One of the things I also wanted to, and this is an abrupt shift in the topic, but since you brought up AI, one of the things that stood out to me last week was when you had SpaceX come out and say we were going to raise X amount of money, it wasn't even the biggest fundraise of the week. I mean, Google came out and did an 80+ billion follow-up placement, and Anthropic came out with I think Series H of 60, 70B. So it's clearly companies don't need to IPO now to raise a lot of money. Do you think it's allowing companies to remain private longer, forever? Or do you think at some point the public markets is still the sort of end?
Yeah, look, I think still all these companies will ultimately be public. And, I still think the public market gives you more options and flexibility for raising capital.
Sure.
So I think ultimately, but there is a lot of there's more private capital, there's more different types of flexible solutions from the private market. So, I think companies have got maybe more luxury of waiting to a point, where you're ready. Obviously being public adds a lot of pressure and extra pressures to being a private company. So, you probably want to only go public when you're ready.
Okay. From an asset allocator perspective, how much do you think people should allocate to private markets? I know that that's an it depends question, but and coming from someone like you, of course, as well, but yeah, give me a sense of what's appropriate.
I don't know. Well, I have 90% of my personal investments in alternatives.
Okay.
Mostly PAG funds, because that's what we have to do.
Yeah, big surprise there.
Yeah, I think, half private, half public.
Half.
But, I'm talking my own book as well.
Right. I was about to say that it depends. Yeah. Well, I mean, okay, it's a final question for you. How do you think your performance has fared through, it's about almost 30 years now, through cycles? You've seen everything.
Well, I think, hopefully, touch wood, we've been around for a long time, so we've survived the world economy and markets throwing a lot of stuff at us. So I like to think we've hopefully been doing something right. I think, there's always going to be some challenges, right? But I think right now performance has been very good across asset classes, actually. Again, I get nervous when you look at areas where too much capital is raised too quickly. That's usually when you start to see, a more difficult investing environment. You tend to then see funds underperforming.
Well, how do you know when something is about to become a problem and something that you could ignore? Like what scares you?
I think you just have to stay disciplined. And, for us as a firm, it's always been very important that we're diversified enough so we don't depend on any one thing. So if an opportunity set goes away, we can just stop doing it. 2018, Australian real estate was getting very frothy. We sold everything. We didn't go back in until 2024. So, I think it's having the flexibility. It's hard to keep that discipline, yeah, I think, if valuations get stretched, well, sell, take profits, I think, and don't be, I think it was Rockefeller or somebody once said, I've become very wealthy by selling too early. So, I think never regret also if you make a good return, yeah.
All right, Chris, fantastic. Thank you so much. Round of applause, please, for Chris Gradel. Thank you.